Markets thrive on confidence, but what happens when uncertainty takes over? There are two major concerns that investors have right now: tariffs and valuations. Could tariffs and sky-high valuations disrupt this market? Well, guys, I'm going to tell you right now, I believe only one of them is a concern, and the other one you should completely ignore. So first off, what's a tariff? A tariff is simply a tax or duty imposed by a government on imported or exported goods. It's used to regulate trade between countries by making foreign goods more expensive, thereby encouraging consumers to buy domestic products. It's also looked at a way of protecting jobs in a country that's imposing tariffs on other countries sending goods to us. Now, recently, it's been in the headlines that our President Trump has imposed 25% tariffs on all imports from Canada and Mexico, 10% on energy products from China, and 10% tariff on overall all imports. Now, here are some examples. Consumer electronics. These are increased prices on smartphones, laptops, gaming consoles, the things that we all use and abuse every single day. These are absolutely ingrained products in our life. Second one, automobiles. Okay, obviously the auto industry is a very powerful industry in this country, and a 25% tariff raises new car prices by $2,700 per car on average. Guys, that's a big number. Now, obviously, a $2,700 difference, if you're looking at a local model versus one that's made by a country that's brought in, it can add up to some significant extra costs. Next one, agriculture. Higher prices for avocados from Mexico and maple syrup from Canada. And then, of course, fashion. 10% tariff on Chinese products, brands like Shein and Temu. End of duty-free packages under $800. Guys, at the end of the day, it's so funny to me when I hear people say like, oh, this product is crap, it's made in China. Guys, every product is made in China. We survive on China and China survives on us. Now, how would it affect these countries? Well, it's actually hard to really decide because at the end of the day, a tariff is going to be an imposition onto you. You know, I was talking to a friend of mine last night on the phone. He was talking about tariffs, and he has a company. We run a company together that imports a lot from overseas. And back in 2018, when there was big tariffs put on China, you know what he said to me? He goes, you know, it's funny, you and your brother were never concerned about it. You just said, okay, let's find a different country to go import from. And that's all we did. And I actually forgot completely that in 2018, there were tariffs put on China. And I was like, oh yeah, that's right. Guys, I don't care about tariffs. You know why? Because at the end of the day, I look at it saying we're either going to find another place to go make the product or the consumer is going to be paying for it, which is me and you. Now, everybody thinks it's a protection of U.S. jobs. It really isn't. It's just an increase in the cost because at the end of the day, if we use U.S. jobs, this ultra wealthy country that we have, everybody here makes so much money. You might sit there and say, well, I don't make a lot of money, but relative to the world, yes, you do. Even a minimum wage employee is making more than the rest of the world. So if we have to make products here, all it's going to do is we're either going to increase the cost of our products made here, or we're going to pay a higher tariff on other countries and just give the US government more money. It's only a tax on you, the consumer. And remember, we've had 100 years, 200 years of history, and there have been tariffs that have gone up, tariffs that have gone down. At the end of the day, incomes keep rising. But you've got to remember that for this country to succeed, you can't have your cake and eat it too. You either want high incomes for everybody, that means we make less goods here, or the other way around. You've got to decide. You know, 15 years ago, I had a meeting with a lawyer, and he said to me, Paul, I just don't know how this economy can keep growing. I mean, we don't manufacture as much as we used to, and it declines all the time. Guys, that was 15 years ago. How much bigger is our economy than it was back then? How much less do we manufacture today than we did back then? Our economy is just changing to a more service-oriented economy. Yes, we can't make widgets. That's okay. And spoiler alert, there'll be a time in the future when we cannot make widgets in China. We can't make widgets in India. We can't make widgets in Thailand, wherever it is. It'll have to go to other parts of the world. And I think Africa is that next frontier. Now, of course, economists will warn that tariffs could exacerbate the inflationary pressures. They're right. The consumer price index is now expected to rise 2.7% in December of 2025 from a year earlier. Now, first off, economists are notorious for being wrong, and 2.7% doesn't sound bad. But guys, again, let's hypothetically say that we all of a sudden increase the tax on every product you bought by 30%. What's going to happen? That's a cost on the good to buy. That's what inflation is. And then what does that mean? Well, then I need to make more money. So I put pressure on my boss, give me more money. I leave the job. All these things work together. And as people make more money, as goods cost more money to make, that's inflation. How do markets get impacted by tariffs? Well, in the short run, I think it's a perception thing. I don't believe it's one of those things that's actually going to cause people and the markets to fall. We have brought up this chart many times in the past. This is the S&P 500 going back to 1950. And yet tariffs aren't on here. But guys, I'm pretty sure that 9/11 is far worse than any tariff we could have. COVID, far worse than any tariff we could have had. All these things have happened and hundreds more. And guess what happened? The economy got bigger. The economy got better. The S&P got bigger. The S&P got better. This is just a blip. This is just the talking point that's in the news right now. Now, the one thing that's ironic to me that is not talked about a lot is valuations. Valuations are the true concern for investors. And if you know me and you've watched this channel, you know that there's two major valuations I look at. And for those of you that are new, here they are. One is the stock market to GDP ratio. And the second one is the 10-year cyclically adjusted PE ratio. Now, let me explain them both in detail. The stock market to GDP ratio is saying, hey, listen, if the GDP of our country is X, the stock market's going to be some sort of percentage of that X. It makes sense. As our GDP grows, so should the companies within that GDP. So over time, you can look at a ratio. I've created my own ratio of the S&P going back to 1928. Now, the S&P didn't exist till 57 or 58, but it's the equivalent going back to 1928. And I will share that with you shortly. The second one is that 10-year cyclically adjusted PE ratio, the 10-year CAPE. What that does, it takes the last 10 years of earnings on the S&P, brings it to today using inflation, and says this is the PE ratio factoring all the last 10 years of earnings to today's market value. Why? Because in any given year, earnings on the S&P can jump up and down. But over long periods of time, you want to see how are earnings on the S&P going up relative to the market value. And guys, it's a little scary out there. Now, for those of you who care about one-year PEs, the current market PE is about 32, higher than its three-year average of 27. Guess what I care about three-year averages? It's stupid. I would never compare three-year averages to absurd highs. You know what that's like doing? That's like being in 1982 and saying, well, the average interest rate for the last 3 years has been 14%, so 13% is a great rate. No, it's not. It's still a crappy rate. So this is the stock market GDP ratio. We're currently at 6,067 in the S&P, and fourth quarter GDP was 29,700,000,000. Guys, we're 116% overvalued based on history. 116% overvalued based on history. Now, a lot of skeptics out there say, well, Paul, you know, the U.S. economy, the companies generate so much money overseas now versus... No, they don't. It's not that big of a difference. If you think it's a big difference, great, take 20% off. It's not even 2%, I don't think. It's still absurd here. Here's the scary part. When we're 50% overvalued or more, the next 10-year returns on average have been negative 0.3%. Negative 0.3%. This does not include dividends. And the overall historical average is 6.94% per year over a 10-year period. We are drastically far from there, and we're at 116% overvalued. How crazy is that? Let's go back to the 2000 tech bubble that everyone tells me was worse, 54.5% overvalued. We are over double the overvaluation than back then. And if you care about earnings and and the companies that earn them, let's go to our 10-year cyclically adjusted PE ratio, because guess what? That does not care where the money was made. It just says, Apple, how much money did you make? We don't care if it was in the US, overseas, etc. Guys, we're 122% overvalued there. We're at 38.23. Historical average is 17.17. These are the two of the most reliable metrics at any given time, as Warren Buffett says about the stock market to GDP ratio. Valuations matter in the long run. The fifth pillar of our principle-driven investing is, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. That means whatever's popular in the short run is going to go up. Whatever's not popular is going to go down. But over the long haul, the most reliable thing is fundamentals. If you pay a reasonable price for a company today and they 10x their profit in the next 10 years, the stock will likely go up 10 times. Now, historically, such great levels of the cyclically adjusted PE ratio have only been observed a few times in their history, going back to 1881, 1929, 1999, and 2007. And this is far worse than those. Maybe not 1929, but in 1929, the Dow ended up falling 86%. Now, do I think that's going to happen again? I do not. But do I think we're going to have a next 5 or 10 years of really bad returns? I do. Will that lead probably to a crash? I do think that. Because when valuations are this high, everything is priced in for beyond perfection. Historically, high valuation metrics like our stock market GDP ratio and our 10-year PE have often been followed by periods of lower than average returns. So, how should you navigate this? First off, my recommendation is don't even worry about tariffs. If you're worried about tariffs, you're worried too much about the short run. Buy great companies at great prices because a great company, even with tariffs, will do well. I actually like short-term problems for companies that suck. Get rid of them. We're not trying to make sure everybody's successful. We want to get rid of crappy companies. Getting rid of crappy companies allows great companies to become even better. Now, in terms of valuation, guys, stick to low-cost ETFs and dollar-cost averaging. Just be ready for substandard returns. But guess what? The one thing I always show people, in March of 2000 to June of 2003, the NASDAQ fell 83%. And if you started dollar cost averaging at the peak of the market all the way to today, you would have made a 15% annualized return. And guess what? I think the NASDAQ's massively overpriced. If it falls 70% from here, you're still about 9 or 10% return on your money, going from peak to bottom. How incredible is that? That's the power of dollar cost averaging. Now, if you want to buy individual stocks, this is a great channel and community for you. We have our community of thousands of like-minded investors who every single day talk about stocks, and we want great people to join. We don't want the fly-by-night people. If you're one of those people who wants somebody to hand you a stock pick, there are plenty of snake oil salesmen on YouTube who will absolutely give that to you. Two things: they're breaking the law and they're dumb. If you want to learn how to fish, we're the place for you. If you want to become better at investing, we're the place for you. We have a principle-driven investing process that works in the long run. So if you want to become a great fisherman, if you want to become a great investor, what's most important is being around people who are like-minded, because the stomach and the emotions are the hard part about investing. So join our community. Click the link in the description below. You can try it out for $7 for 7 days. That's $1 per day. And be ready to buy great companies when the prices fall. Because guess what? The world isn't going to end, and there will be much better times to buy great companies at really awesome prices. I'll see you in the community. Thank you for your time.